Intercompany transfer of services. In this learning objective, we're going to look at the downstream sale of depreciable assets or equipment and the consolidation accounting. We'll start at the beginning where we have the current year activity between the parent and the sub, which you can see we get from the book value schedule to get the EJE, and the NCI comes from the book value schedule as well. So does the subsidiary's equity. You can go and look at the PowerPoint lecture notes for EJE 1, 2, and 3 if you need to as you review. Let's focus on the special allocation items, and in this case there's more than one. And our three-part worksheet after the first EJE is posted looks like this. Okay. And here's a quick snapshot of what's there. One, the subsidiary has depreciation expense of $27,143. The parent has a gain on the sale of the land in this year of $32,500. We can see that the equipment has a value of $190, and then that accumulated depreciation is $27,143 on the sub side. A couple of things that we know. One, that depreciation is a little high. It should be $22,500. We know that the gain should be deferred. And we also know that in the consolidation process, we have to state all of the assets and liabilities at their correct value. And in this case, the equipment had an original cost of $225. And there was some depreciation or accumulated depreciation that was there as well. So with this allocation process, we're going to go through and address each of these items. Let's start with the equity method entries that we made during the year. If you remember correctly, the first one we did was the unrealized gain, and we removed that, so we debited income from subsidiary, credited the investment for $32,500. Well, with the EJE process, we need to eliminate that, so we're going to make the following entry. Debit investment subsidiary, credit income sub. The next thing we did was depreciation, and this is the entry we made under the equity method during the year. We debited investment, credited income for the excess depreciation amount. So we need to eliminate that by doing the following. Debit income from subsidiary, credit the investment account. So at this point, we have eliminated all the equity method entries we did. So that means that there's a few things there. And what's there is there's that gain on the parent's records of $32,500. The equipment is also there. And remember, we said it needs to be at $225,000. And we also said that there is no accumulated depreciation, or the amount that we originally took off is not there. So what we're going to do in EJE 6 is a multitude of things. The first thing we're going to do is we're going to eliminate the gain on the sale. And we're going to debit gain on sale. The next thing we're going to do is we're going to reestablish the equipment at the original cost. So remember, the equipment is sitting on the subs records at $190. And what is it going to take to get us to the original cost amount? So we're going to debit the equipment $35,000. $190 plus $35,000 gives us $225. And then the last thing we're going to do is we're going to reestablish the accumulated depreciation that was there when the asset was sold. And remember, that accumulated depreciation represents depreciation from year 4, 5, and 6. So we're going to make this entry here. It does three things. It eliminates the gain. It reestablishes the equipment. at its correct value, and it reestablishes the accumulated depreciation at its correct value as well. The last EJE we're going to do is we need to look at the excess depreciation. Okay. All right, let's kind of work through this in our mind. On the three-part worksheet, we saw that the depreciation expense on the subs records, because remember, the only party depreciating that equipment now is the sub. So on the subs records, they, in X7, debit depreciation expense $27,143. They credited accumulated depreciation $27,143. So at this point, they've taken too much depreciation, which on the subs records, that's fine. We're going to leave it that way. What we're going to do is during the elimination process, we're going to correct any excess depreciation that was taken during the year. So what we're going to do is, in this example, we're going to debit accumulated depreciation for the excess amount, $46.43, and we're going to credit depreciation expense for $46.43. And kind of think of what that does. On the subs records, there's depreciation expense $27,143. This credit here is going to bring the depreciation expense down to $22,500, where it should be. Here's all the EJEs recapped. And I think we get a clear picture here when we look at this three-part worksheet. And let's address each line, since there's so much going on right here. And we're going to start with, let's start with depreciation expense. I think the income sub is kind of self-explanatory, but we'll come back to that. The depreciation expense, before we eliminate anything, is $27,143. We see with that EJE7 that we reduce depreciation expense to $22,500. Let's go down to the gain on sale. EJE6 eliminated that gain on sale. And also in EJE6 we did a couple of things. We won on the equipment. We reestablished the equipment's value to $225, which is what we originally paid for it. The other thing that we see is that with EJE 6 and 7 in accumulated depreciation, we bring the accumulated depreciation total to its correct value. And let's work through this. The depreciation expense that we computed for the parent was $22,500. And with this particular asset, we're in year 7, so we have year 4, 5, 6, and 7. That's 4 years. If we take $22,500 times 4, what do we get? We get $90,000, which is what the accumulated depreciation would have been had they not sold it. So EJE 6 and 7 together bring the accumulated depreciation to where it needs to be. And let's jump back to the income sub line, and we see here that we've got the parent's net income sub is $28,000, and it consists of several numbers. The first EJE is to eliminate the current year activity. EJE 4 is to eliminate that equity method entry for the deferred gain during the year, and EJE 5 eliminates the excess depreciation we took during the year. If we look at our consolidated net income, we can see that the consolidated net income is getting to have several items in it. And there's an error here. If you find this error, I will pat you on the back. I'm not going to offer you any extra credit points, but a nice pat on the back. So we see the net income plus any income sub, any deferred gain, and any excess depreciation. And none of this is allocated to the sub. Now, one thing I want to point out here, just briefly, is that the excess depreciation, even though the subsidiary is depreciating the asset for the $27,143, this excess depreciation amount of $46.43 is going to be assigned to the parent. The reason it's going to be assigned to the parent is that is where the transaction started. So that depreciation started with the parent and the sale was sold from the parent to the sub. So in a downstream transaction like this, that excess amount will stay with the parent.